Well, we've got jobs reports on both sides of the border, perhaps giving us some early insights into the potential impact tariffs are going to have on the labor market. Joining us now to discuss, Lauren Belay, VP for Active Fixed Income Portfolio Management at TD Asset Management. Thanks so much for joining us today.
Happy to be here. What a day.
What a day. There's a lot going on. There's a lot more that's going to go on, probably even while we're speaking. Usually in an environment like this, jobs are very important. And not that the reports aren't important, but things are moving so quickly. Let's break down what we know so far and start with Canada.
Sure, yeah. So what we saw from Canada this morning was a weaker jobs report. We saw the unemployment rate increase 0.1% to 6.7%, with Canada losing about 33,000 jobs. Now, unfortunately, when you look at the underlying details, it was also weak. All the job losses we saw were in full-time jobs, and we also saw that the participation rate declined. So not very strong details underlying. So overall, weaker than expected. Not really a great handoff going into what we know is going to be turbulent, more turbulence going forward. But we'll just keep an eye on jobs data going forward.
The American labor market, however, and of course this was all ahead of the tariff information we got this week, was pretty resilient again. What do we read into that? And the market doesn't seem to be putting too much weight on it at this moment.
Yeah, so on kind of opposite to Canada, we actually saw a stronger jobs report in the U.S. They added 228,000 jobs. Their unemployment rate did increase a touch to 4.2%. But that was just on higher participation. So that's a good reason to have your unemployment rate go up. When we take a step back, I mean, what we've been seeing recently from things like initial jobless claims has been a relatively resilient and stable jobs market in the U.S. So this is in line with that. But, taking a step back, well, both of these numbers were for March. It's still backward looking. And right now we're dealing with a very different situation going forward. So the market is right now focused more on that broader macroeconomic situation, and that's what's driving markets right now.
Yeah, a lot changed on April 2nd, and that was only 2 days ago. So we have these jobs reports, as we said, backward looking. We now have this global tariff backdrop. You start thinking what it means for central banks, the Bank of Canada and the Fed. And we just heard from Jerome Powell. He doesn't seem to be in a rush to take any action based on these early innings.
That's right. So it is a very fluid situation, but we do see scope for rate cuts in the future, with the Federal Reserve likely being able to provide more accommodative policy than Canada, just in terms of how many cuts they may deliver. And that's because the U.S.'s starting point is from a higher rate. So in the U.S., the overnight rate is still 1.75% higher than where we are in Canada. So ultimately, what actually happens is going to come down to central banks monitoring things like inflation, growth, and employment, and how they evolve, or how expectations around these factors evolve. And that will definitely be impacted by this global tariff situation. And just, thinking about what's the depth of tariffs that we ultimately end up with, how long they stay in place for, and also what the federal or just general government response is to tariffs to help support the economies through this time. So when we look at Canada right now, pricing in about a 60% chance of a cut at their upcoming meeting in April. That's actually up even from when I looked last night. That was zero. So again, things are changing. And that is also due to the jobs report that we saw this morning just being weaker. When we look further out over the next year, seeing about 3 cuts priced in for the Bank of Canada. And again, that's up by about 1 cut over the past week. When we look south of the border, right now for their upcoming meeting, which is in May, there's about a 40% chance of a cut priced in right now. Again, that has also been rising. And when we look further out to the end of the year, we have 5 cuts priced in. So 2 more than what we're seeing priced in for Canada. And again, that has also come up just over the past week. So ultimately, this is what the market's pricing right now. As I mentioned, some of these numbers have even changed since last night, and it's going to continue to depend on how policies evolve in the future. We'll be watching that closely.
A very fluid market environment. People are watching right now what's happening out there in terms of equities, but also fixed income, because people are, thinking about their portfolios. In an environment like this and where we may be headed, what role is fixed income playing right now?
Yeah, so right now fixed income is playing the role of a portfolio diversifier. That's exactly what you would expect in a risk-off market. So we've seen interest rates have rallied. So just looking at the US 10-year over the past week, that's come down by about 40 basis points. So it's now sitting around just below 4%, which was a key level for markets. And now we've broken through that. When you put that into context, you might be thinking tariffs, like that should be causing inflation to go higher. Could that possibly make rates go higher? Which has been a fear, especially with inflation being so fresh in everyone's memories. But what the market is telling us right now is that the overall change in the macro backdrop, with potentially this global tariff war causing weaker growth going forward, that could outweigh the kind of risk that we're seeing on inflation. So when we look at expectations from people do expect inflation to go up, but it is more of a near-term thing at this point. When we look at market expectations, what we're seeing is that market expectations of inflation are actually coming down just over the past couple of days. So showing that the growth is outweighing inflation at this point for fixed income. So just taking a step back, what does that leave fixed income at for the year? Right now, I think in Canada, I'm going to check here because it's a very fluid situation.
Changes by the moment.
Yeah, so in Canada, right now, for the universe, we're up about 2% year to date, and the US up 3.5%.
That's the fixed income side. When we start drilling down into different parts of the market, the credit market is fascinating, particularly in an environment like this when we're worried about the economy. What are we seeing here?
So we have seen some weakness in the credit market, but not nearly to the same extent that we've seen in equities. So we've seen a bit of an adjustment in credit spreads just to the slower growth backdrop and the heightened levels of uncertainty. But the general moves in credit have been very well contained. Just thinking about overall index levels right now of about 110 for US investment grade and 400 for U.S. high yield, that's still below long-term averages. So right now, market is not pricing in, the risk or telling us that there's a risk of an imminent recession.